Hello, testing, testing, testing. Jimbe Hala. Jimbe Hala. Are you ready? Customer revenue analysis is looking at just the sales side of customers. It's not looking at the cost. And we'll talk about revenue first, then cost. We put them together and guess what we get? Get customer profitability. Here's my friend in Malaysia, Honson Apple Tree. He was telling me about an example where they had dictaphones and they had lots of interesting issues with trying to manage their suppliers in China in making these Instadict type dictaphones. And they had to deal with suppliers in some ways. Some suppliers were more profitable than others. It's the same concept. It is the same concept. One side of the value chain or the other. Some customers are more profitable than others. Some suppliers are the same. Here's what we mean on the revenue side. When you try and make a sale to a customer, sometimes you have to give some discounts. Others, you can make sales without a discount. Others will complain more. They will complain, okay? Your goods are faulty, and they will have a very strict standard when it comes to that. Others will just not complain, and maybe they don't get as many sales and returns and allowances. So in some ways, some customers give you more revenue per dollar than others. Others take more sales effort per dollar. That is, you have to give discounts to this one and this one, but not the middle one, HomeServe. Let's have a look at how that transfers into different revenue. So we have office supply. This company is selling office supplies to 3 customers. Advanced Tech, wonderful, 540,000, lots of sales, and you think, oh wow, that's our best customer. But no, wait, you need to look at the finance charge. Cash discounts given to this customer, the finance charge given to this customer. Because maybe why do you have to have a finance charge? Because maybe they're slow in paying, okay? Then you don't have to do a discount, but this one is fast in paying, so therefore what happens? You have to give a discount, okay? If you offer, this one pays at the right time, so there's no financing charge, and here with the sales discount, at the sales, in order to get the order, you don't have to offer the sales discount, so therefore the middle customer is quite good. Okay, so that's on the sales side. When we talk about finance charge, sales discounts, cash discounts, it's all about getting the customers to make a decision to buy from you. All right, so that's why we call it on the revenue side. It's not a cost. Okay, it reduces the potential revenue you get from the customer. Right, there's Grace. Thank you again, Grace. We have customer cost analysis. See, revenue on one side, we have cost on the other side. And we have a hierarchy. Have you seen this before? This is something like ABC, where some costs vary according to unit, some costs vary according to order, some costs vary according to customer, some costs vary according to facility, okay? And a facility may be a country or it may be a district. With that hierarchy, all we are saying is that the cause and effect is different. Remember, what did we say right at the start? What's the basic principle for cost allocation? What is it? Cause and effect, right? Benefits received. That's what the hierarchy is about. If we go to the unit level, the cause and effect between the shipping of one extra unit is there's a cause and effect with that shipping of that unit with the cost. But then we go down to the facility level, that cause and effect between one extra unit and the corporate charges, the accounting charges, any administration, that doesn't register, whether you ship 10,000 or 100,000. Okay? There's no cause and effect there. So the cause and effect is very, very strong at number 1. As we go down to number 5, the cause and effect gets weaker and weaker and weaker. You see that? That's all we're doing with the hierarchy. Okay? So if we can have an activity that it represents 1, 2, 3, 4, 5, these different levels, then we can better, more accurately reflect the cause and effect. That's all we want to do. We just want to reflect the cause and effects that's going on in the organisation. What is causing costs to be incurred? Okay. Right. In Management Accounting 1, you weren't told there was a hierarchy. You just said, oh, you just have a whole rate. Okay. So you're assuming that the cause and effect for everything incurred in the organisation is the same. Now MA2, no, let's break that down into a hierarchy. All right, so order size, visits, commercial versus retail, maintaining sales, firm sales capability. Okay, so learning objective 6. Remember the first 2 learning objectives dealt with cost allocation and principles of cost allocation. 4, 5 and 6 are associated with customer profitability analysis. Okay. 7 and 8, sales variance analysis. We're going to come to that in our last 20 minutes of the session. So we have accounts receivable, carry-in, return. We're going to have a look at these, how they're exampled. Not all customers require the same kind of activities. And I want to come to an example and then move ahead. Okay, so that's in your notes. Let's have a look at the cost side. We have the same. This is the same company. It's an office supplier. They're supplying to 3 customers. Let's have a look at the incurrence of costs according to the different hierarchy. In other words, according to different cause and effect. When we take orders, it's really driven by the customer batch level. Some customers do orders many times, maybe every week. Some customers may just order end of each month. Some customers make 1 order at the end of 3 months. Yes? Now we go down to customer visit. Wow. That's a sustaining cost. Maybe you don't do that too much. Maybe in China you have to do it many times. Okay, why? You know, the relationship is very, very important. I remember a friend of mine who was CFO of Roton Limited. They did a $500 million IPO in Shanghai back in 2002. And so I did study with him for a short time in the US back in the mid-90s. And still a good friend of mine. Anyway, he was telling me every year at the Mooncake Festival, you know the mooncake? So, when we give gifts to people, if they're hundreds of miles away, you just put it in a post and deliver it. Well, he was telling me he has to physically go and hand it to people. Okay, that was the culture, and that's China. They physically go and be there and give the mooncake to people. So that's what we mean by customer visit. Okay. All right, because most of their customers were the government telecoms and the agents of these telecommunication companies. All right, customer cost analysis. Now, here's our hierarchy of activities, costs. These are the driver rates and the category. Now we can look at those 3 customers and then we can do an allocation. Even before you do the numbers, I think you can tell me which customer is going to cost more. You should be able to get an idea by what activities, what things are causing costs to occur. Average items per order, 400 or 8. Which would you prefer? 400. Yeah, not 8 items, especially. Why? Oh, I want to order a pen. How many? Oh, just 1, please. Just 1 pen. 1 pen, right? Okay, I don't think they like customers like that. All right, so this is what we mean. Maybe this is advanced tech here. Okay, but a customer that orders 400 at a time obviously is going to be much more less burdensome on your organisation costs. All right, what about the number of requests? Sales returns, advanced tech 10, home serve 1. Number of visits having to be made. Which one requires more maintenance? Advanced tech, but not Jericho. You get the idea now? Not all customers are the same, number one. Second point, some customers require different incentives to make a sale. That was revenue analysis. You know, incentives like financing, discounts, and returns, right? Now we're on the cost side. Some customers behave differently when they order. They order in small lots or they order in large lots. Some customers will complain about getting orders on time, so you've got to expedite orders so they keep them happy. You see that? All right, so we're just breaking down, we're just trying to understand, you know, we've got millions of dollars of costs on our book. Which customers are really causing those costs? Which customers are not causing those costs? That's what we want. If we know that, we can make better economic decisions about our future customer strategy. Do we want more of one type than another type? Well, before we answer that question, which type is the one that is more profitable? Okay. All right. And so we have you don't need me to go through the calculation. I think you know where we're headed here. Okay. All right. It's not for me. You have this in. Oh, you don't have the numbers. So they're omitted from your slides. Is that correct? Yeah. Okay. I did not do that deliberately. Okay. Do you believe me? No, I didn't. Seriously. All right. I'm honest. All right. I didn't do it. It was a printer error. Print out. Okay. So we have 2, 20, and 80. 1, 2, 5, and 2. Okay. 1555 and 10795. Can you read that? Wait a minute. Let me help you. Let me help you. Oh. Okay, all right, doesn't work. All right, 10795, all right? 10795, okay, got that? Have we got that? Everyone got that? Everyone happy? Are you happy? Yes. Up the back, are you happy? Sleepy. All right, so now we have the revenue, costs, and then profit at the bottom. I guess you're writing down 0, 0, 50, 4585, okay? Did you get that? All right, I apologise for that omission. I didn't mean to print it out that way. Remember you print out colour, grey and black and white? I think I selected black and white, so it didn't give it just caused this to be white. Okay. 50 down here and 4585 in the middle at the bottom. All right, have you all got that? We good? Yes. Good. Okay. Now, remember I showed you earlier that cumulative profit line? As you get near the 100% and then the last 5% and then the profits start going down again because those last are really unprofitable. Well, here's how you construct something like that. I'm going to show you reference. My job in the lecture is just to pick your interest in some of the examples that are in the chapter rather than tell you everything about that example, okay? So this is an example in your chapter about how to construct a cumulative curve like that, all right? So here we have various customers, A, B, of course, C, D, E, F, and G, and then H, I, and J, okay? All right, so there's many customers, not just 4. They just show that as an example, okay? Notice they all have revenues. There's price discount, there's costs, and then the operating costs of various customers, and then the final operating income. Notice some customers are very, very profitable. Wow, some customers are not very profitable. Can you all see that? All right, so let's move on. Let's just go up one more level because What you got here are the retail channels. So circle that. That's the retail channel. So when you go to the example in your textbook, you'll see it's just circle. We're just looking at retail. Because when you go from the exhibit 14.5 to exhibit 14.6, now they give retail and wholesale. So immediately it can be very confusing. Okay, they give you the retail and now they give you retail and wholesale. And you think, oh, where does wholesale? You didn't show me that before. How can you show me that now? That's not fair. Okay, so just look out for that. The previous exhibit just focused on the retail customers. And notice you already have customer A and B in there. 35, 100, 52, circle those two. That's exactly the same as 35 here and 51 here. Can you see that? See the consistency there? But now we've just jumped up into a distribution channel level. Why do we jump up here? Why? Because we want to allocate distribution channel costs and we want to allocate corporate sustainability costs. So we allocate it to the channel, not to the customers. That's a different type of economic decision. Let's go to the next slide. Are you ready? Now we're going to make that cumulative distribution based on the retail distribution channel only, okay? Not both, we're just doing one. And that's where we have exhibit 14.7, and we can see customer A is here, the 35,100, customer B is 51,6. So if this was in your Excel file, you do a sort, and so you get the highest to the lowest, and then you can graph that, and you're going to get some kind of distribution. Any questions on that? Are we good on that? We're good. Okay, and so the distribution will look like this. Is this real? Is this just a textbook thing? Or does organisations really do it? Well, I showed you a real example of insurance company. What about another company? I wonder if another company does it. Let's think of a famous battery manufacturer in China. Now, who would that be? Battery. Come on. Huh? Everready is a brand. Battery manufacturer. They make competition to Everready. Come on, people. Oh, let me give you a hint. The nationality of the manufacturer starts with J. Japanese. Okay, come on. The name starts with S. Samsung is not Japanese. Oh man. Oh, I got you on that one. I'm sorry about that. Okay, all right. Sony. No. Very famous. When I was a kid, this company was the Sony. Okay, so we're talking about the 70s. Okay, before Sony came famous with its Walkman. It's Sanyo. Okay, so we're going to show, let me show you the example. I think I got it here. Oh, it's not here. Anyway, Sanyo did this. One of my cases, it's a Sanyo case study, is in my book, and if you want to, you could do a presentation on that case. But it's a customer profitability analysis of their various customers, including Panasonic, Motorola, all the electronic companies you know about. Why? Because they make batteries, they make DVD drives, they make all different things for these customers. And so as a supplier, they actually have these customers, and look at them, some of them more profitable than others. Okay, I did have the graph, maybe on another version, but I'll show you that when I pull it up. What other factors need to be considered when evaluating profitability and PME? Exactly what you said. Customers that are profitable today or not profitable may be profitable in the future. Okay, that's probably the #1 consideration. And so here are the 4 things. I just want to draw your attention to the chapter in the book. So this is in the chapter, it's not new, so we move past this a bit. But we want to Oh, sorry, you don't have this. You know why I know? You know why I know that you don't have it?
We're all writing down.
No, because I put a little star. Because just before I print it out, I always delete the pages with a star on it. So I know that I've got it, but you don't have it. Okay. But you do have it because it's in your textbook. This is in your textbook. What, you don't want to buy the textbook?
I got a textbook, but it's 13th edition.
Yeah, that's good enough. It's good enough, as long as you get the right questions in the tutorial, and there may be a few changes. I'm not sure if there's many changes.
For example, chapter 5 is totally changed.
Well, that's only one chapter. Yeah, all right. All right. Someone asked me, is there any textbooks available in the bookshop? What you need to do is put in your order, okay, and then the textbook's coming. I don't know why they changed their policy and how they deliver to orders.
There are only 2 available in the bookstore.
Yeah, but Cassandra inquired, and just go to the bookshop and put your name down to get the book. Okay? All right? Okay, likelihood of retention, potential for sales growth, references, long-run profitability, increases in demand, ability to learn from customers. While you're writing that down, the midterm test will include the first 4 weeks of material. Okay, first 4 weeks. Everything up to the start of capital budgeting, but won't include capital budgeting. Okay, all right. Okay, is everyone clear about that? And I will work with Cassandra to set the test. It will be, most of it will be multiple choice. Okay. Okay. We will try to keep it close to an hour and 10 minutes. I can guarantee it won't be longer than the time it took me to run the half marathon on Sunday. Okay. All right. All right. So it's all about, we need to, some of the economic decisions may be to do with loyalty, growth opportunities, and reputation. Okay, let's do a summary. What do we mean? What have we done so far in the lecture? Number one, probably the whole theme was about cause and effect. Cause and effect. The whole theme. When you want to make economic decisions and you want to create analytical power in terms of information to support decisions, a lot of things you're doing is about making visible cause and effect. That's all you're doing. Think about it. Think about it. If you had total visibility of the whole business model of the organisation, maybe you don't need accounting. Maybe you don't need accounting. But we don't have total visibility. The people at the top or making economic decisions, they don't talk to Grace every day about the customers. They don't see everything that Grace sees. And they don't have time to listen to Grace to talk, listen to her to talk for 3 hours about all her, one-on-one experiences with the dialogues with customers, who's good customer, who's bad, and all that. So what do? We get the management accountant in to create some analytics, like customer profitability, put it into a report, then send it to top management. So top management don't have to waste time listening to Grace for 3 hours, talk about every one of those 100 customers. Okay? I know it's bad to depersonalize something that's very important in the relationship management area, but that's the way corporate decisions are made. Okay? Real experiences between the organisation and customers are transferred into analytics. Then those analytics are used for economic decision making. So what we've been doing in today's lecture was show you how some of those analytics are formed, okay, in terms of who's more profitable, who's less profitable. And what is the basis for that formation? A lot of it is just cause and effect. One customer orders many more times fewer things, though they cause more costs in terms of the ordering department taking the orders, processing. Then another customer that orders less but larger things, so they cause less things to happen in the ordering department. It's all about cause and effect. What is cost allocation about? Cause and effect. What are 2 of the 4 principles of cost allocation? Ability to bear? Fairness? What are the other 2? Benefit received and cause and effect, right? So it all boils down to cause and effect. What is cause and effect? It's basically the model of the organisation. What are you learning in playing that game every Tuesday? What are you learning? You're trying to learn the cause and effect. If you know the cause and effect, you know the whole algorithm that supports the game, that is all the programming. If you know all that, then you don't have to think about making decisions, because you know, oh, we changed that number there, we changed that, we changed that, we changed that, run. Okay, now we change it this way, run, and then we can get that perfect profit at the end, right? Because you know all the cause and effects. But because you don't know that, like every other businessman doesn't know that, when they look into their own organisation, we create a backup. We try to make visible that by using accounting, by using analytics. And that's what we're learning in management accounting. We're learning the analytics that make visible the business model that you're working with. Okay? And today's analytics was customer profitability. So that takes us to another set of analytics. Sales variance analysis. Wow. So is that easy? Of course it's easy. See, this is what you learnt in MA1, I think. Oh, let me tell you something how to make it very easy, and how, if you're in my MA1 class, what we do is we have T accounts, right? How many of you have done MA1 at Hong Kong U? Most of you, I hope. Okay, all right. And so with T accounts, we buy materials, then we allocate them to work in process, then we allocate them to finished goods, then we allocate them to profit statement, and so forth. And so if you're in my class, it's like a monkey swinging from branch to branch, you know, like this. That's all you're doing, all right? Just swing, swing, swing. So my whole way I teach variance analysis is get the order in which you're swinging from one to the other. Okay, get that right and you cannot go wrong. Okay, the other way is just memorize all the formulas. Okay, so I can teach you my way, then you decide what you want to do. All right? Okay, so we're not in MA1 and we're not looking at the T accounts for cost of goods sold in the organisation. We're looking at sales variance analysis. So here's something that happens every year, no matter whether you are accounting for something or not. We're talking about the static budget variance. The static budget variance is basically caused by, we have actual quantity times what? Quick. Actual contribution margin, which is basically price minus costs, right? Or revenue minus costs. Okay? And that could be several products. Right? Look, if you don't do any variance, you don't do any accounting, you have to know that. Why? Because a bill comes to your door asking you to pay, or revenue comes into your bank account to say you've got more money. Actual times actual, that's a transaction. The organisation's transaction with the world is the actual times actual, no matter whether you're doing variance analysis or not. So always start from there. Right at the other end over here is the budget side. Budget. And we can talk about, well, for each product we have a budget quantity and we have a budget what? A budget contribution margin, which may be a budget price